I have been trading since the summer of 1967, and yes, that makes me an old guy. The good news being that I've been around for a long time, still around, still trading practically every day. A little bit about me, besides trading all these years, I've been on Wall Street Week, CNBC, written 40 books on trading. I've developed a number of very successful trading strategies. I have written the 5 best-selling books on day trading, although I'm not a day trader per se. And I believe that everything I do has to be completely objective. So I don't use words like maybe. I don't interpret anything. In fact, I don't even use candlestick charts because candlestick charts have too much information and I find it confusing. It's very difficult to be in a business where most people lose money most of the time. And my hope and my mission, indeed my desire is, if you're making money, I want you to make more of it following my methods. Oh, Dave, how much time do we have till, what is the time that I end my session today?
Hey, you've got 39-minute presentation here, so if you're on Pacific time, 10 o'clock.
Okay, got it. Thank you so much. So as I was saying, thank you for being here today. And if you are here today, it's for either of 3 reasons. Number 1, you're just getting started and you're looking for methods to use. Number 2, you're losing money. Number 3, you're making some money, but you know you could be making more because at the current rate, you're getting as much as a fast food worker is making because you're spending many, many hours a day and time over the weekend and you're not getting success with it. So we're going to talk really briefly about a couple of things, give you an introduction to what I do. There won't be any commercials except at the very end. I'll put on a link for my mid-year forecast, which will be in a couple of weeks. So the bottom line, you can lose money trading. In case you didn't know that, here's a disclaimer. Never trade with money you can't afford to lose. Always know your risk before you trade, and so on and so forth. The most important thing I can tell you is this. Most people in this business, as I said before, lose money, and they can't figure out why. Part of the reason is, and there are at least a dozen reasons, part of the reason is their methods are not specific. They don't have rules. They bend the rules. Even if they know what the rules are, they bend the rules. They don't start with enough money. They don't understand the risk. They don't understand the markets. They don't understand how to place orders. They don't understand the meanings of orders. They get too much information. They're reading too many newsletters. They're doing things that are too difficult to do. They've got charts with so many colors and lines in them, they don't know where to go with it. So the bottom line is this. Everything you do as a trader must be 100% objective, clear by the rules, so that 10 people looking at the same chart who have the same rules will reach the same conclusion every single time. That does not happen in today's markets. The other day I was watching the TV and I saw a commercial for a brokerage firm, and they were bragging about the fact that their brokerage firm offers you 400 different indicators. 400 indicators. What are you going to do with 400 indicators if you don't even understand one indicator? Most indicators have no explanation. They just have market mythology or folklore, like the 50 and the 200-day moving average cross, the so-called golden cross or death cross. If you do something which most people don't do, put the rules or the algorithm for that 250-day, 200-day crossing over on the computer and ask the question, does it work? Does it have predictive validity? Does it predict anything? The good news is there's a lot of indicators to test. The bad news is most of them are complete rubbish and don't have any predictive ability whatsoever. Because the most important thing you can have before you have a timing trigger is a trading model. So let me explain the trading model to you. My trading model, and by the way, if there's only one thing I can teach you, if there's only one thing that I think can really turn your trading around, it's right here. After this, you don't need to listen to anything else unless you want specifics. The trading model that I use, which took me 15 years to develop, setup, trigger, follow through. Let's talk about each piece of the puzzle. Setup. A setup is a pattern. Everything in the markets is a pattern. By which I mean, for example, head and shoulders is a pattern. Flag, pennant, reversal, key reversal, stochastic, ADX, RSI. These are all patterns. And we look at these patterns in order to make decisions. So the first thing you need is you need a good pattern. Seasonality is a good pattern. It can be back tested. If you can't back test your methodology, whatever it is, it probably doesn't work because it doesn't have specific rules. If you can't put it on a computer, you can't test it. If you can't test it, don't trade it. So for example, I could give you 9 different indicators and say, RSI is doing this, stochastic is doing this, we have a reversal here, we have support here, we have resistance here, we've got divergence here, make a decision. That will not work. You need a specific indicator or setup. I'll show you one today. The setup needs a trigger. So just because you have a setup that's been right 75% of the time for the last 25 years, that doesn't mean that it will be right this time, because right, after all, 75 is not 100. 75% means 75%. 25% of the time you'll be wrong. You can decrease the error rate by having a trigger. So a trigger is what most people call timing. I call it a trigger for a pattern. The third step, which consists of 3 parts. Your first profit target. Where are you able to take some money off the table and reduce your risk effectively to 0? That's target number 1. Number 2, what is your risk? What's your stop loss? How much are you willing to risk? Make that decision before you take the trade and determine that once you enter that trade, it's a losing trade. One moment, please. Once you make that trade, it's a losing trade. Deduct the money from your account, at least mentally. Number 3, the part that almost everybody gets wrong, the profit maximizing strategy. How can you turn that $450 profit into a $4,500 profit? Most people don't know that. Why? Because they're so conditioned that as soon as they make a little bit of money, they say, ooh, I made a $450 profit. I better get out, or I better get out fast before it disappears. They get out, and over the next couple of days, the stock moves to $2,000 profit, and they're not there. So setup, trigger, and follow through. I'm going to show you one method of setup, trigger, and follow through today. One more thing. You will notice I do not use candlestick charts. Why not? Not because they're not pretty. They're very pretty. But for me, it's TMI. Too much information. The more information you have, the more difficult your decision will be. It's not only that. There's a lot of bad information. So most of the information that you're using is bad information, by which I mean it does not back test profitably. So abandon all that stuff. If your chart's got lines and colors and moving averages here and there, and reversals and lines and support and resistance and interpretations and blah, 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 you're about to lose money. Don't do it. You need something that's specific, cookbook, and clear. We know, for example, that seasonality is highly effective. We can look at a stock and we can say, in the last 50 years, buying on such and such a date, selling on such and such a date, end of day, risking 5% close only stop would have been profitable 77% of the time. That is a complete methodology because it will also provide a profit target, a risk analysis, and so forth. But as I said before, most people don't have that. In order to be a good trader, you have to look in the mirror and be honest with yourself. You have to look in the mirror and say, I am a bad trader. My trading sucks. It needs to improve. How do you do that? You do that with specific methodologies. So if you hear the words, look like, might bottom, maybe put your stop here, put your stop 1 tick under the low of the move. These are all common conclusions, common statements that are associated with losing behavior and losing money. So let's talk about convergence and divergence, or congruence and divergence. What does divergence mean? Divergence means, let me show you, difference. The difference between 2 indicators, the difference between 2 events, one event moving in one way, the other event moving the other way. So 2 things going in opposite directions at the same time are divergence. We can look at a chart and we can see what's normal and what's not normal. Let me show you what I mean. Here's a normal chart. It doesn't matter what the chart is. As I said before, remember, I don't use candlesticks. They have too much information. You will get good and confused. So, nice, simple, open, high, low, close chart. At the top of the chart, we've got price. At the bottom of the chart, we've got an indicator. It doesn't matter what the indicator is. In this case, it is specifically momentum, close 28. We're not going to change the momentum close 28 to close 14 for this particular stock or 7 for another stock. It's always going to be momentum close 28 as one of my 4 indicators for divergence. Let's distinguish the difference between normal and abnormal. In my former lifetime, working as a clinical psychologist in a mental institution, that's right, I still do the same kind of work today, but I get paid a lot better. For the first few years after college, I worked in an institution from 1968 to 1972. I learned a lot about behavior at that time. I learned about normal and abnormal behavior. Normal behavior. Things are just cruising along. The market's going up, the market's going down. Everything seems to be normal. The price is going down and the indicator is going down. Everything's normal. Normal teaches me nothing. Normal behavior means nothing to me, especially in the market. If something's acting normal, you get lulled into a false sense of security and you're saying, oh, everything's fine, nothing to worry about. However, when things stop being normal, that precedes changes in direction. So I'm always looking for abnormal behavior in the markets. Divergence as a deviant, etc. The term divergence means away from the normal. I'm looking for divergent opportunities because these divergent opportunities precede change. So in this chart, for example, price going down, indicator going down. Price makes a low, indicator makes a low. Price going up, indicator going up. Price goes down, indicator goes down. Price goes up, indicator goes up. Everything is normal. I learn nothing. However, I'm looking for that small opening, that window of opportunity that says to me, things are about to change. Think of it like this. You work in an office building. You're at the water cooler every day. You see Jack at the water cooler every day. You have small talk. Everything's fine. Everything's normal. One day, Jack shows up at the water cooler wearing a dress. You are in a very tolerant society. Living here in California, we tolerate things like that. You don't make fun. You just do your best to accept it. Jack is wearing a dress. First sign that's diverging from the norm. You come back the next day, Jack asks for your phone number. You might think, now it's really getting divergent. Something's going on here. I have a trigger. So, no offense intended to anyone. It's just an example. Markets do the same thing. And there's nothing wrong with wearing a dress to work if you want to do that, provided your employer is okay with it. So, let's go on with it. We'll stay away from politics. So, in this case, everything's normal. I'm looking for an abnormal situation. Let's look at another one. Here is another situation. In fact, in this situation, I've got price with 4 indicators that I use that measure divergence. The trick is, how are we going to spot the opportunity when things become abnormal? So in this case, we've got momentum 28, MACD 9 and 18, commodity channel index, and detrended oscillator. So these are the 4 that I use. Today I'm going to talk only about the rules for momentum divergence, but the rules for application for all of these are the same, which leads to the question, then which one do we take? We take the one that triggers first. If the one that triggers first is too risky for you, you take the one that triggers second, knowing that you might not get a second opportunity. Let's talk a little bit about risk. It's very important to remember that risk, in my view, should always be related to the methodology. Every methodology gives its own degree of risk. So it's not a question of what you can afford to risk. Clearly, If the methodology says you need to risk $5,000 on this trade, then that $5,000 is either too much for you, or just right for you, or not enough for you. Either way, the methodology determines the stop. It's not something you determine in your head and say that's all I can afford to risk. It's always the methodology. Please remember that. So let's go forward and look at the next slide. Here we go. Here is a situation that's abnormal. Why? Because look, price is going down, indicators going sideways to higher, indicators going sideways to higher in all of these cases. And in this case, which is not as clear as it could be, in a moment we're going to make it extremely clear that price going down, but momentum and the other indicators starting to go up. How do we isolate these? This is the trick that I'm going to show you right now. And it is very simple. It is in all respects an absolute cookbook. I respectfully submit to you that if you can't get this right, you're not going to get anything right. So pay attention, please. Here's a chart. It's a very current chart of gold. Here's the cookbook. Top of the chart, I've got price. Bottom of the chart, momentum, close, 28. I look at the chart and I ask the question, where is the highest high on this chart? The highest intraday high. That is on this day right over here. Looking to the left on the chart, I can see something very interesting. Price goes up and makes a new high. Momentum does not. In fact, momentum has been going lower. And by the way, this methodology is so simple, even a computer can do it. So I'm going to do something very simple. I'm going to draw a line from the high of the price all the way down to the bottom, and I'm going to put a line there. It's going to look like this. One moment, please. It's going to look like this. How's it going to look? Come on, computer. There we go. So let's do some labels. This is point A. This is point B. You can see that A is making a new high, B is not. Clearly, I have divergence. Because price is going up and momentum is going down, I have bearish divergence. The next move will be to the downside. I want a piece of that. So I'm going to go to step number 3. Step number 1, 2, 3. Find the highest momentum previous to point B. We can all agree on that. It's completely objective, no interpretation. It's right over there. I'm going to put a line there like so, if the computer will cooperate with me. And there's my situation. Point A, point B is in Bravo, C is in Charlie, D is in Delta. A is higher than D, while B is lower than C. Look at the chart, study it for a minute. Bearish divergence will always look like this. There may be more days between the points, there may be fewer days. As a point of information, I must have at least 6 bars between points B and C. 6 or more. Why? Because in backtesting, we know that works. 6 is just right. 6 or more is right. Less than 6 is wrong. If it's an intraday chart, it's 6 intraday bars, at least. If it's a weekly chart, it's 6 weekly bars, etc. Very simple. So I've got my setup. Let's think back to setup, trigger, follow through. Now that I've got my setup, I need a trigger. What's the trigger? Easy. Find the lowest momentum between these points. Agree, that is right over there. Let's put it on the screen. There it is. Now what happens? When and if you drop below this number, which is 20, and you will notice this is very specific to a number. It's a specific number. It's not an interpretation. It's not a maybe. It's not about. It is an exact number. If at the end of any bar, after the divergence has been established, you close the bar below this number right over here, which is 20, you have a trigger to go short. Setup, trigger, follow through. So that's what the chart looks like. Here's what happens. It goes short over here. It sits through a little pain over here, and then it has its biggest day down in many years on Friday last week. So that's just an example. There's more coming. So how do you know what to sit through? We have a specific stop loss for this methodology, which is calculated using the range that occurred within the period of divergence. Given enough time today, I will show that to you. Let's look at another one, just in case you didn't get it. And remember, this is a piece of cake. It's completely objective. There is no way two people can look at this chart and reach a different conclusion unless I'm a bad teacher or unless they've got a learning disability. And I'm not a bad teacher. Let's go to the next chart. How about this one? Here's Apple. In fact, this chart is Apple as of today. So, as of yesterday. So what do we have showing here? What's the procedure? Was the big move up in Apple preceded by a divergence? Was the big move in Apple preceded by a momentum divergence buy signal? Was it preceded by a momentum divergence buy setup? Piece of cake. Let's do it. The rule is simple. It's the other way around now. Find the lowest intraday low on the chart. That is right over here. I hope you agree with me. If not, we have a problem. Put a line on that chart. Okay, we'll do that. Now we've established our 2 points, A and B. Move to your left. In this case, find the lowest momentum between previous to point B. Looking for a high, we'll find the highest momentum. Looking for a low, we'll find the lowest momentum. And I think you'll agree the lowest momentum is right over here. How do we know it's the lowest one? Again, look at the numbers. Because this can be done by a computer, we're able to generate our setups and our triggers. Today, we're doing it step by step so that you can see the process. And by the way, do not believe anything I tell you. Do not believe anything anyone here tells you until you've seen it yourself and tried it yourself. Otherwise, it's just interpretation, assumption, and so forth. Don't believe it until you see it yourself. We're going to put a line over here. There's our divergence. Now what? A, B, C, D. A is lower than D, while B is higher than C. What's the third thing we need? We need a trigger. In this case, we're going to find the highest momentum between these two lines inclusive. We're going to put a line there, like so. And when we break up from that line, we get a buy, and that was right over here. Now, normally these divergences will trigger very, very quickly, much sooner than this one did. But if you're like most traders, which I assume that you are, you're going to look at this chart and you're going to say, exhaustion gap. I will look at this chart and say, breakaway gap. I will look at this chart and say, buy trigger. Most of you will look at this chart and say, oh, I knew it was going to bottom right over here. My answer to that would be, okay, smartass, if you knew that, why didn't you buy it? Or you're going to say, I'm going to wait for the pullback. What pullback? To where? To support. Okay, where's support? How do you know where support is? Do you have an interpretation of that? So here's the chart, and your profit target and your stop loss are going to come from here. And I will show those later on. Let's go to another one. I would love to take questions. I can't do that. There's just not enough time because Dave expects me to teach everything that I've learned in 52 years of trading in 30 minutes, and I just can't do it. Maybe if I had 90 minutes, I probably could. Let's go to the next slide. How about this one? Here's Adobe. Do you see something happening in Adobe right now? I do. The lowest low in price, not the lowest momentum. A, B, C, D. And by the way, I'm looking at a window of 60, that's 60 bars. So if it falls outside the 60 bar window, it's not included in the determination of the pattern of the setup. Let me show you something. How about Uber? Very simple. Again, the same process. Lowest point on the chart, A, B, C, D, E, and trigger. So Uber triggered about a week and a half ago and is in the process of taking off. In fact, Uber has already reached its first target because remember the profit target calculation is determined by what happens in the period of divergence. That profit target calculation and stop is the range between the highest high and the lowest low during the period of divergence. So if I'm going a little bit too fast for you, I'm sorry. I think Dave's going to be sending out recordings. So go through this step by step. And as I said before, don't take my word for it. Try it yourself. Oh, by the way, point of information. Look to the left over here. What do you see? Oh, look. New high in price, not a new high in momentum. So this is the opposite situation that developed right at the top, but we'll talk about that another time. Right now, we're just looking at this one. Let's go to the next slide. One moment, please. Next slide, please. Here we go. How about looking at Apple again? There's Apple. There is gold, the gold ETF. New high in price, A, B, C, D, E, trigger. So it's no surprise that the gold spider, the ETF, looks very similar to the gold chart. The trigger was right over here to go short. Sometimes you have to sit through a little bit of pain, but that's what trading is all about. Most people give up when they feel pain. We don't. We know what our pain is going to be before we get into a painful situation. How about this one? UNG. For months and months, everybody and their brother waited for a low in natural gas. A low in natural gas. Well, look what's happening. You can see that even visually, price keeps going down, but momentum keeps on going up or remaining steady. It's a prime candidate. What's the procedure? Let's go through it again in case you didn't get it the first few times. Here we go. Find the lowest price on the chart and put a line there. Like so. Do we have divergence? Yes, we do, because there is a lower momentum previous to the left, but this is the lowest price. The lowest momentum, put it on the chart, right over there. Now we've got our picture complete. And by the way, please observe not just what I did do, but what I didn't do. What didn't I do? I didn't talk about the economy. I didn't talk about the mathematics of natural gas. I didn't talk about greenhouse emissions. I didn't talk about electric vehicles. I didn't talk about OPEC. Didn't talk about production quotas. Didn't talk about stochastic. Didn't talk about RSI. Didn't talk about any of that stuff. I just use a simple cookbook methodology that's available to anyone who's willing to have the patience, the persistence, and the perspicacity to understand this method and to apply it with discipline. As you know, and you've probably heard this preached to you 1,000 times by now, the weakest link in the chain is you. The weakest link in the chain is me. And even after all these years, 50 plus years of trading, I still make a mistake every now and then. And I know where I made that mistake. How do I know where I made that mistake? I keep a journal. If you don't keep a journal and write down why you made each trade, what was the trigger? What was the setup? What was the follow through? Unless you do that, your memory won't be good enough to remember everything you did in that trade. And if you can't remember the past, you're going to repeat the history. One more thing about that. Most traders believe that if they learn from their mistakes, they won't make the same mistakes. That may be true, but they will come back to make a mistake that's a brother or the cousin or the uncle or the sister or the brother of that mistake. You want to learn from your profits. So every time you take a profit, ask yourself the question, what did I do right? What helped me make money on this trade? What did I do correctly? How did I follow the rules? Maximize the learning from the profitable trades because there's only a few things you can do right, but there's 1,000 things you can do wrong. Let's go to the next slide. And there's the trigger, and there's the follow through. Piece of cake. Not perfect. There is no perfect, but there is procedure, and procedure is clear. Let's go to the next one. How do we get these trades? That's easy. we have a scanner. Practically every strategy, every trading methodology, every trading application platform has the ability to scan. So we went through and we programmed the scanner and asked the question, show me a list of all those stocks that are showing, in this case, bullish divergence. In other words, for this group of stocks, which we identified, and by the way, you want to be very selective in the stock groups that you select because you don't want to have too much duplication and you don't want to have stocks in there that are trading at 2,000 or 3,000 shares a day. You want substantive stocks, stocks that have volume, stocks that have a history behind them. And so our list is very small, relatively speaking, but you'll notice there's some big names on this list. And what it says is this: every stock on this list made a new low in price as of the end of the day it was run, without making a new low in, without making a new low in momentum. So we can take from this list and draw a screen, put it on the screen, and see the divergence right in front of us and work from it. So let me go to another slide. Here's an example. On the list was Masco, right over here. I don't need to know what Masco is. I don't care what they do. I don't want to know their earnings. I do know just from general knowledge that Masco works on new construction homes and roofing. And so naturally, if you're looking for reasons, they would be declining because the housing market is difficult because of interest rates and all the rest of that stuff. That, dear ladies and gentlemen, is clutter. It's too much clutter for my mind. I have no room for that BS, but I do have room for this. Here's the chart of Masco. And what does the chart show me? Very clear. It shows me the situation that I explained to you before. It's a setup. New low in price without a new low in momentum. A, B. Go to the left and find C and D. There's my divergence. And this one here would be my breakout point right over here. There's a couple of more things you want to remember about this. So for example, if momentum here makes a new low in price, a new low below this point over here, divergence is negated. There is no divergence. There's no trigger. There's no setup. There's nothing. So the good news is this works. It will absolutely amaze you in any time frame, but it won't amaze you if you don't give it time to do its thing. If you don't give it the opportunity to develop and try it and see for yourself. Give yourself an opportunity to look at it at least in 100 cases so that you can convince yourself of three things. Number one, that it works. Number two, that you know how to do it. Number three, that it's profitable enough to give you some good trades. Let's look at another chart. Another one that was on the list, TAP, Molson, right over here. Here's the symbol, TAP, Molson. So let's go have a beer, and here's the chart. So in my trading, I use a lot of different indicators. Not a lot, I shouldn't say a lot. I use what's called the moving average channel, expansion, contraction, seasonality, divergence, which is what I taught to you for you today, and the commitment of traders report. There's a lot of information here. But what I want you to do is this: go back to the methodology, look at the recording, and see for yourself if it works for you. If it doesn't work for you, if you're not clear on the methodology, send me an email. My email is rulesbasedtrader, that's rulesbasedtrader@gmail.com. I'm going to send you an invitation to, hold on one moment. Dave, where can I send a link to everyone in the room?
You know what? I already put it in the chat there.
Thank you so much. I appreciate that. Okay, yeah, there it is. Okay, so that is my mid-year forecast. If you're interested in what my projections say for the next 6 months to a year, you come to the forecast. It's in about 2 weeks. Take the discount price there, and we'll see you there. But let me show you something else. I'm going to skip forward here, so just bear with me for a minute. I want to show you the kinds of information that we use in our trading besides expansion and contraction. Check this out. This is a cycles chart of Japanese yen versus US dollar. It's a long-term chart. These cycles run approximately 7 to 8 years, almost perfectly from low to low. Most of the time they will top mid cycle right over here. So here we are right now. This is the current chart. What does the chart say? And remember, setup, trigger, follow through. In terms of what I taught you, this is a setup. It says over the next 2 years, 3 years, the Japanese yen will likely gain a lot of ground over the US dollar. So what do we do with it? We need a trigger. We've got 3 triggers that I use: moving average channel, momentum divergence, and expansion contraction. Those are my 3 main triggers, and they're all completely rules-based, as I showed you previously. So we also have cycles, for example, in soybeans. This is the soybean cycle. It consists of 2 different cycles, a smaller one and a bigger one. Again, within the context of what I teach, this is a setup. It's not a trigger. It doesn't say that soybeans will have bottomed right now. It simply says they are bottoming and waiting for a trigger. If you're not a futures trader, that's no problem. We take the proxy and we trade Archer Daniels Midland, the world's foremost grain processor, and so forth. So Dave, I think my time is up. I don't want to overstay my welcome. I want to appreciate the opportunity you gave me to speak here today. I hope that everybody's listening. Folks, keep it simple. Don't get involved in too much of this interpretive stuff. It's going to serve you very poorly, and you will be a loser, and you won't make nearly as much money as you think you should.